Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Imagine, lending your life savings to a friend's business,
Right.
and they promise to pay you double the normal interest rate,
Mhm.
which, sounds fantastic, obviously.
Yeah, it always does.
But there's a huge catch hidden in the fine print. You are absolutely not allowed to ask for your money back when a sudden personal emergency hits.
Yeah, that's the kicker.
Right. And that invisible trapdoor is currently quietly locking up billions of dollars in the financial world. So today, we are putting a magnifying glass on a massive trend sweeping through the markets called private credit.
Mm-hmm.
More importantly, based on recent analysis, we're looking at a hidden danger inside this market that researchers are calling the liquidity illusion.
Yeah, that is the perfect term for what is happening right now. When you look at the market data coming in, as of late June 2026, you see this enormous stress test unfolding behind the scenes. For the past few years, people have been pouring just incredible amounts of money into private credit because they are, chasing those high returns.
Oh, absolutely.
But the fundamental problem emerging right now isn't just that some of these loans might go bad. It's about a broken promise.
Okay, a broken promise. How so?
It is the sudden, very harsh realization that the ability to get your money out of these investments exactly when you need it, it might not actually exist.
Okay, let's unpack this, because for anyone listening who is, just trying to make sense of where to put their hard-earned retirement money, Wall Street jargon can feel like a totally foreign language.
Oh, for sure.
Before we get to the trapdoors and the illusions, let's just establish the absolute basics. What exactly is private credit in the real world?
Okay, so think about how business borrowing traditionally works. Normally, when a mid-sized company, let's say a regional chain of dental clinics or a mid-sized software firm.
Right, like an everyday business.
Exactly. When they need a huge amount of cash to expand, they do one of two things. They either go to a traditional, highly regulated bank for a commercial loan, or they issue a public bond that anyone can buy on the open market.
Makes sense.
Private credit completely bypasses that traditional banking system. It is when specialized asset managers or alternative investment funds step in and lend money directly to these companies.
Wait, let me stop you there, because why wouldn't a company just go to a regular local bank like Chase or Wells Fargo?
Right.
Doesn't a massive traditional bank have cheaper money to lend out?
Yeah.
Why use these specialized asset managers?
Well, traditional banks do have capital, but ever since the 2008 financial crisis, they are operating under incredibly strict government regulations.
Oh, gotcha, the red tape.
Exactly. They have to keep a certain amount of cash on reserve, and they cannot always take a chance on, say, a rapidly growing software company that doesn't have a lot of hard physical assets to put up as collateral.
Right, you can't repossess a line of code.
That's a great way to put it. Alternative investment funds do not face those exact same banking regulations. So they step into the gap. They tell the company, we will lend you the money quickly and we will be flexible, but you are going to pay us a much higher interest rate for the privilege.
Okay, so that makes sense for the borrowing company. They get the cash fast.
Hmm.
But what about the people supplying the money to those investment funds? The investors?
Well, between 2020 and 2022, when interest rates at regular banks were basically sitting near zero.
Yeah, a savings account paid basically nothing.
Right. So these private credit funds were marketed to investors as the ultimate alternative. They offered incredibly high interest payments, what the financial industry calls high coupons.
Hold on, I want to clarify that term for our listeners. Because when you say coupon, I'm thinking of like a discount on a box of cereal at the grocery store.
Yeah, it's a funny word for it.
What does that mean in the investment world?
It is an old terminology from the days when bonds were physical pieces of paper. They literally had little tear-off coupons at the bottom that you would mail in to get your interest payment.
Oh, wow. Literal coupon.
Yeah, exactly. So in today's market, when we say a private credit fund has a high coupon, it simply means it pays out a very high regular stream of interest, cash, to the investor.
Okay, nice.
But the high interest wasn't the only selling point. The biggest attraction was that these funds seemed incredibly stable.
Really? How so?
Because these private loans are not publicly traded on a stock exchange, their prices do not bounce around every single day.
Ah, I see. Because if I'm an everyday investor, I'm used to opening my brokerage app and seeing the numbers flash red and green every single second.
Oh, yeah, it's just...
If the stock market is having a bad day, my portfolio looks terrifying. But with private credit, because it's essentially just a private contract between a fund and a company. There is no stock ticker. So instead of buying a stock on an app, it's like lending money directly to a friend's mid-sized business, or like your brother-in-law's local plumbing business. It looks completely stable because you aren't checking a screen every day that tells you the value of that loan just dropped by 10%.
You are hitting on the absolute core mechanism of the illusion there. The lack of a daily price ticker creates a profound psychological feeling of safety.
Right.
The value of the loan isn't jumping up and down on your phone screen so you sleep well at night. But just because you aren't looking at a fluctuating price doesn't mean the underlying plumbing business isn't struggling to pay its bills.
Yeah, the business could be going under.
Exactly. The risk is absolutely still there. It is just hidden from plain sight.
Okay, so if this setup pays so well and looks so incredibly stable on paper, who is hitting the panic button? Because according to a recent Reuters report from January to May of 2026, an astounding $12.9 billion was pulled out of private credit funds aimed at wealthy individuals.
Yeah, that's a staggering number.
It is a massive amount of cash rushing for the exit. What is going on?
To understand that rush, we have to look at the mechanics inside these funds, and a recent real-world example gives us the clearest view. Look at the data surrounding Ares management.
Right.
Ares runs a massive $22.6 billion fund called the Ares Strategic Income Fund.
And looking at the research, in the second quarter of this year, investors requested to pull out a massive 14.4% of the fund's total shares. That is billions of dollars trying to leave all at once.
They certainly tried, but the fund did not give everyone their money back.
Wait, they just said no.
They simply couldn't do it. Following standard practice for these types of unlisted semi-liquid funds, Ares limited the actual cash payouts to just 5% of the fund's net asset value.
Oh, wow.
In the private credit industry, this limitation is known as a gate.
Let me translate that. Almost 15% of the money wants to leave the building, but the fund managers drop a heavy metal gate and say, sorry, only 5% of you are getting out this quarter. The rest of you are staying right here.
That is the reality of the structure. What's fascinating here is how this gate is a double-edged sword.
How so?
You have to understand why that gate exists from an economic perspective. The underlying investments in this fund are direct loans to private companies. You cannot simply log onto an app and sell a private, complicated loan in an afternoon to raise cash.
Right, there's no buyer just sitting there.
Exactly. If the fund was forced to give every single panicking investor their money back all at once, the fund managers would have to call up other financial institutions and sell off those private loans at absolute fire sale prices.
Oh, like selling a dollar for 50 cents.
Precisely. That would completely destroy the value of the fund for all the other investors who decided to stay. So from a structural standpoint, the gate is a necessary safety valve.
I understand the math, but think about how that feels to you, the individual investor. It's exactly like being inside a very crowded movie theater with only one tiny exit door.
That's a good analogy.
The small door prevents a dangerous stampede, which is technically great for the structural safety of the building. But if you're inside and you smell smoke and you want to leave and you suddenly realize you cannot fit through that tiny door.
You panic.
Yeah, you suddenly realize you're trapped. That realization completely shatters the liquidity illusion we talked about.
It shatters it entirely. It is a very harsh reminder that a private credit fund is not a high-yield savings account where you can just transfer your balance to checking whenever you feel like it.
Right.
Now, we do need to look at the data carefully and provide some nuance. This is not a full-blown, panic-driven, systemic bank run just yet.
Okay, that's good to know.
Yeah, the reports clearly show that the vast majority of these redemption requests at Ares came from a specific subset of international investors and large family offices. In fact, if you look at everyday U.S. private wealth investors, their request to leave only made up 2.4% of the total, which was actually down from the previous quarter.
But wait, if the everyday U.S. wealth investors are largely staying put and the sky isn't totally falling, why are those massive international funds and family offices panicking?
That's the big question.
Because interest rates have been high for a while. So the fact that borrowing companies have higher payments isn't exactly breaking news here in 2026. What is the hidden catalyst driving the smart money to hit the exit right now?
The catalyst is something nobody was talking about in the context of private debt 3 years ago. Based on recent analysis, the unexpected culprit causing this stress is artificial intelligence.
Okay, let me challenge you on that, because here's where it gets really interesting. Usually, when we turn on the news, AI is the hero of the economy.
Sure.
It's
Yeah.
driving major tech stocks to record highs, making investors incredibly wealthy. But you're saying inside these private loan portfolios, AI is actually the villain, destroying the cash flow these companies need to pay their debts. How does an AI chatbot destroy a company's ability to pay its debts?
It all goes back to how these massive private loans were handed out between 2020 and 2022. During that era, private equity firms were aggressively buying up hundreds of software companies.
Okay.
And to fund those expensive purchases, they used massive amounts of private credit. The logic from the lenders made perfect sense at the time. Software companies operate on subscription models.
Right.
If you sell enterprise software to a hospital or an accounting firm, they pay you every single month. That means stable, recurring revenue, incredibly high profit margins, and strong pricing power. If you are a private credit manager lending out billions, a software company looks like the safest, most predictable bet in the entire world.
It sounds like those old premium cable TV packages we all used to have.
Oh, absolutely.
You know, you hated paying the high monthly fee, but you needed the channels, so the cable company was guaranteed to get your cash every single month. Lenders looked at software companies the exact same way. Guaranteed cash flow forever.
But then, generative AI exploded onto the scene. And suddenly, the landscape for traditional enterprise software changed practically overnight.
Yeah.
AI tools are rapidly learning to perform the functions of older traditional software systems. A startup can build an AI tool that replaces a legacy software program in a matter of months.
Wow.
This completely destroys the pricing power of those older software companies. Businesses that looked like incredibly safe bets for a private loan just 3 years ago are suddenly facing intense competition. Their customers are leaving for cheaper AI alternative, and their revenues are falling.
To use the analogy, AI is the sudden arrival of Netflix,
Yeah.
and these heavily indebted software companies are the old cable providers watching their subscribers vanish.
Exactly.
Their cash flow drops, their profit margins shrink, and suddenly they realize they cannot afford the massive interest payments on that private credit loan they took out in 2021.
You've nailed the mechanism perfectly. And remember what we discussed earlier about the illusion of stability. Private loans do not have a daily price ticker. They do not reprice every day based on bad news in the tech sector.
Right, there's no red arrows flashing.
Exactly. So the fact that these legacy software companies are struggling against AI, that catastrophic loss in value is completely hidden from the surface. It happens slowly, buried in quarterly financial statements that most people never read.
But the smart money, the massive institutional investors and family offices, they read those statements. They know the rot is there even if the price ticker hasn't moved yet.
They absolutely do. Institutional investors despise opacity. They hate not knowing exactly how much financial damage is sitting hidden inside a portfolio. So rather than wait around for the fund managers to officially admit that these software loans might not be paid back, they hit the redeem button.
Just get out while they can.
Yeah. They try to squeeze through that tiny theater exit door and get their cash out before the bad news becomes official. In private credit, the actual financial losses show up late, but the redemption requests show up early.
Let me see if I have this straight. We have billions of dollars of trapped money, massive hidden technological risks from AI, and tiny exit doors that slam shut when people actually want to leave.
That's the situation.
Given all of that, you would assume Wall Street would be stepping back and being cautious. But based on the data, the big banks are actually doubling down. They're actively trying to push private credit away from the billionaires and sell it to everyday wealthy individuals, the retail investors.
This is perhaps the most critical and concerning development in the entire financial market right now. We are witnessing a massive coordinated push to retailize this asset class.
Let's translate retailization. Basically, the financial industry is taking an illiquid investment strategy designed for massive institutional pension funds, and they are repackaging it to sell to a middle-class American's retirement portfolio.
Yeah, that's exactly what's happening.
According to recent SEC filings, JP Morgan is pushing a brand new kind of fund called an interval fund, designed specifically to attract individual wealth. And their big marketing pitch is that they are trying to fix that tiny exit door.
That is their proposed solution. They're proposing a structure that, if the SEC approves it, would allow everyday investors to cash out monthly.
Oh, monthly. That sounds way better.
Well, specifically, they want to allow redemptions of at least 2% every month, up to a maximum of 25% over a 3-month period. Even their baseline traditional structure aims to offer 7.5% redemptions every single quarter, which is significantly higher than the standard 5% gate we just talked about with Ares.
That sounds like a neighborhood bank installing an ATM that only lets you withdraw $20 a day, but marketing it with a giant banner that says unlimited 24/7 access.
Right, yeah, it's marketing.
On the surface, to an individual investor, it sounds like a massive upgrade. More liquidity, a bigger exit door from the theater.
It sounds incredibly appealing, but it ignores a fundamental law of financial physics. Liquidity is never free. It always costs something.
Walk us through the math on that. Why does giving an everyday investor the simple option to leave their investment actually drag down the performance?
Let's break down the mechanics. Imagine you manage a fund with $100 in it. If you take all $100 and lend it out to a company at a 10% interest rate, your fund makes $10 in profit. That is a great return.
Sure.
But now, imagine you promise your retail investors that they can cash out every single month. To honor that promise, you cannot have all your money tied up in long-term, illiquid loans. You have to keep $20 in a vault entirely in cash just in case people hit the panic button.
Oh, I see. So now you only have $80 actually working out in the market, earning that high interest.
Exactly the problem. Cash sitting in a vault does not earn a high yield. That immediately drags down the overall return of the entire fund for everyone.
Wow.
But it gets worse. If more people want to leave than the cash you have on hand, the fund has to borrow money from a bank to pay out the leaving investors. Borrowing money costs interest, which further drags down returns.
Right.
Or, in the absolute worst case scenario, the fund is forced to sell off their best, highest performing loans at bad prices just to raise cash quickly. Every single one of these actions, holding dead cash, borrowing to pay redemptions, or conducting fire sales, actively hurts the returns for the investors who patiently decide to stay in the fund.
So what does this all mean? Big banks are basically putting an express checkout lane in our crowded theater. It sounds like a great perk, but it just makes the underlying structure more fragile.
Yeah, that's exactly right. If we connect this to the bigger picture, this is why the Financial Stability Board, or FSB, has issued a very stark warning about this exact trend.
Okay, the global regulators are watching.
They are looking at the macro level, and they are deeply concerned. When you take an asset that is fundamentally illiquid, like a highly complex 5-year private loan to a struggling software company, and you aggressively sell it to retail investors who have a strong tendency to panic and pull their money during bad news cycles, you are creating a very volatile mix.
It's oil and water. Everyday investors expect to be able to hit a button on their phone and have their cash in their checking account by Tuesday. Private loans simply do not work that way.
They don't. The FSB isn't predicting a 2008-style apocalyptic collapse tomorrow, but they are pointing out a severe structural vulnerability. When you tangle together giant asset managers, traditional banks, and retail investment platforms into one complex product, the ultimate risk becomes completely obscured. When true financial stress hits the system and every single retail investor tries to leave at the exact same time, it becomes incredibly unclear who is actually legally and financially required to absorb those massive losses.
Right, because a massive institutional investor, like a state pension fund, has a team of lawyers. They understand that when they buy private credit, their money is locked in a vault for 5 to 7 years. They do their own deep dive into the loan collateral.
Exactly, they know the game.
But an individual American investor often relies entirely on brand trust. They see a giant famous name like JP Morgan offering a high yield, and they inherently assume the product is as safe and liquid as a regular savings account. But a famous logo on a brochure does not magically make a failing software loan easy to sell.
That is the ultimate danger of retailization. The transition of private credit from a quiet, boring, long-term institutional market to a flashy retail product with promises of monthly redemptions is a massive structural shift in our economy. It is going to be the ultimate stress test of this liquidity illusion.
If you are listening to this right now, looking at your own retirement portfolio, or perhaps sitting across from a financial advisor who is pitching you on the amazing high yields of a private credit fund, what are the absolute core lessons you need to take away from this data?
First and foremost, you must internalize that private credit is not a high-yield savings account, it is not a certificate of deposit, and it is absolutely not a substitute for holding emergency cash. The only reason these funds pay such a high interest rate is specifically because you are surrendering your right to withdraw your money whenever you want. That high return is your strict financial compensation for giving up your liquidity.
You are literally being paid a premium to be locked in a room.
Second, you have to look past the psychological illusion of stability. Just because a private loan does not have a daily stock price that flashes red during a bad week on the news does not mean the investment is immune to risk. As we saw with the massive hidden impact of generative AI on legacy software companies, the business fundamentals can deteriorate very quietly, and the financial losses will only be revealed much later when you try to leave.
And finally, pay very close attention to the fine print on the exit doors.
Absolutely. Do not look at a marketing brochure promising monthly or quarterly redemptions and assume it means you have full unrestricted access to your cash. A 2% monthly limit or a 5% quarterly gate is not a guarantee of liquidity. It is an explicit legal limitation on your money. When the economy turns sour, you better believe that heavy metal gate will be pulled down immediately.
It really completely changes how you look at these financial products. They aren't inherently bad tools, but they're increasingly being dressed up and sold to the American public as something they fundamentally are not.
Yeah, that's the real issue.
And that leaves us with a final, lingering thought to mull over based on all this analysis. As these private credit interval funds become more and more popular with everyday middle-class investors, the next time the market truly crashes, not just a small quarter-to-quarter stress test, but a genuine, widespread economic panic who is actually going to be forced to provide the mountain of cash when millions of people rush for that tiny 5% exit door at the exact same time. Don't forget to subscribe and hit that like button.